For many of us, tax season conjures up images of, well, overflowing folders and that looming deadline.
Right.
But imagine you're not just wrangling receipts, you're also, cultivating the land, nurturing livestock,
Uh-huh.
and then trying to decipher an equally complex landscape of tax forms. It's a lot.
It's absolutely true. For farmers, navigating the IRS isn't just about what you report. It's really about how you report it strategically.
Hmm.
And the IRS's publication 225, often called the Farmer's Tax Guide, well, it holds the keys to understanding your responsibilities and, crucially, unlocking some significant savings.
Exactly. And that's really our mission today. We're going to cut through the dense text of that guide
Yeah.
to unearth the most important nuggets of knowledge for preparing your farm tax returns, item by item. We're talking about transforming tax season from, a dreaded chore into a powerful financial opportunity for your farm.
Let's do it.
Okay, let's dive in. So before we even think about filling out a single tax form, let's talk about the absolute bedrock of good tax preparation, your records. Why are they so critical beyond just being, well, a compliance thing?
Oh, records are absolutely the unsung heroes of farm finance. They're vital for accuracy, obviously, when you're preparing tax returns and financial statements.
Right.
They provide that solid evidence for every income stream and every expense. They're also your best friend for making smart management decisions and, let's be honest, making any IRS inquiry a much, much smoother process.
Okay.
The good news is you have flexibility. Whether they're old school physical ledgers or, modern electronic files, it doesn't matter as long as they clearly track your income and expenses.
So it's not just about checking a box for the IRS, it's about clarity and really protecting your business.
Precisely. And there are specific timelines you need to know. For instance, employment tax records. Keep those for at least 4 years.
4 years, okay.
And records for assets like your machinery or barns, you need to hang on to those until the period of limitations expires after you've actually disposed of them.
Hmm.
This is crucial for correctly calculating things like depreciation and your basis.
Right, the basis, that's basically your investment cost, right?
Yeah,
For figuring gain or loss.
exactly. It determines how much profit or loss you have when you eventually sell.
All right, so once those records are in tip-top shape, how do we choose the right accounting method? It sounds like it's definitely not a one-size-fits-all kind of decision.
You're right. It absolutely isn't. Your choice of accounting method dictates when you report income and deduct expenses, and it can significantly impact your tax picture year to year.
Okay.
The first, and often the simplest, is the cash method. With this, you report income in the year you actually receive it,
When the cash is in hand.
pretty much.
Yeah.
And you deduct taxes in the year you pay them.
That sounds straightforward enough, but are there any, clever ways to leverage the cash method for tax savings?
There are definite strategic maneuvers. Now, you can't just hold on to a check someone gives you in December to push income into January.
Right, the IRS frowns on that.
Yeah, that doesn't work. But you can defer income if you sell a commodity, say, under a legitimate, bona fide, arm's-length contract that explicitly states payment will be made in a later tax year. That's a common strategy.
Okay, so a formal contract is key there.
Absolutely. And regarding expenses, generally you can't deduct prepaid expenses that cover a period extending substantially beyond the current tax year. However, and this is important for farmers, there are special, more flexible rules for prepaid farm supplies and livestock feed. We'll dig into those specifics later under expenses.
Good to know. What's the other main method?
The second method is the accrual method. Here, you report income when you earn it, regardless of when you get paid.
So when the service is done or the product delivered.
Exactly. And you deduct expenses when you incur them, regardless of when you actually pay the bill. The idea here is to match income and expenses to the exact tax year they relate to. Now, it's worth noting that some larger farm businesses, particularly certain corporations or partnerships with corporate partners, are actually required to use this accrual method.
And what if a farmer starts with one method?
Yeah.
Maybe cash, because it's simpler, but later realizes accrual might be a better fit, or vice versa. Is it easy to switch?
Generally, changing your accounting method requires IRS approval. It's not automatic. You typically request this by filing a specific form, Form 3148, application for change in accounting method. It's not something you can just decide on your own year to year without going through the proper channels.
Okay, so that's a planning point. This is where it gets really interesting, right? Understanding how these methods impact when you recognize income and expenses. It's not just about what you make, but when you count it.
Mm.
That timing can be huge for managing your tax liability.
Absolutely. It's all about the timing.
So let's turn to the heart of every farm, the income. Where does all that hard-earned farm income go on your tax return, and what are some of the less obvious sources? It's got to be more than just crop sales, right?
Oh, absolutely. While direct sales are fundamental, most farm income eventually funnels onto Schedule F, Form 1040, which is titled Profit or Loss from Farming.
Schedule F, got it.
But when you report various income streams, offer some surprising opportunities for tax optimization, especially focusing on those savings.
Okay, let's break it down, starting with the basics.
Right. Sales of farm products. Pretty straightforward. Whether you grew them or bought them for resale, you report the proceeds on Schedule F. And remember, proceeds includes anything of value: received money, other property, even services if you barter.
So if I trade hay for some repair work, the value of that work is income.
Exactly. Fair market value. Now, here's a crucial strategic insight, especially for farmers facing Mother Nature's curveballs: sales caused by weather-related conditions.
Like drought.
Precisely. If you're forced to sell more livestock than you normally would in a year because of drought, flood, or other weather events, you can often elect to postpone reporting the gain from those additional sales until the next tax year.
That's a big deal for deferring tax.
It's a powerful deferral tool, helps smooth out income. You need to meet specific conditions, obviously, like the area being designated for federal assistance, and include a statement with your return detailing a situation.
That's a great example of the tax code providing flexibility. What about things like crop shares or income from renting out pasture? Is that always Schedule F income?
Not always. For crop shares and pasture income, the reporting really hinges on your material participation.
Okay, what does that mean exactly?
It means, are you significantly involved in the production or management decisions related to those farm products or the land? If you are materially participating, the income typically goes on Schedule F and is subject to self-employment tax.
Right.
However, if you're not materially participating, maybe you're just a passive landlord collecting cash rent for pasture, then that income usually goes on Schedule E, Supplement Income and Loss, or sometimes Form 4835, Farm Rental Income and Expenses. And importantly, it generally isn't subject to self-employment tax in that case.
That's a key distinction for SE tax savings.
Huge difference. And the rules for renting machinery or equipment can also vary. If you rent machinery with land, like in a sharecropping arrangement where you provide equipment, it might follow the material participation rules. But if you just rent out equipment on its own without land, it could be considered a separate trade or business reported on Schedule C, or perhaps just other income, depending on how substantial and regular the activity is.
Okay, lots of nuances there. What about government payments? Ag programs.
Yes, agricultural program payments. These are usually reported on Schedule F. A prime example involves Commodity Credit Corporation, or CCC, loans.
Right.
You have a choice here, which is great for tax planning. You can elect to include those loan proceeds in income the year you receive them, or you can wait and treat the loan as a true loan, reporting income only when you actually sell or forfeit the commodity securing the loan.
So that election gives you timing flexibility.
Exactly. And related to government programs, you mentioned the Conservation Reserve Program, CRP, earlier. There's a specific potential self-employment tax benefit here.
Tell me more about that saving.
Absolutely. This is a significant tax optimization point. If you're receiving Social Security, retirement, or disability benefits, you can actually exclude those CRP payments when calculating your self-employment tax.
Wow.
It's a nuance that can put real money back in your pocket, so definitely check the Schedule SC instructions if that applies to you.
Definitely worth checking. Okay, what else?
Another fantastic strategic opportunity, really focused on saving, comes with cost-sharing exclusions for improvements. You might receive payments under certain federal or state cost-sharing conservation programs.
Like for improving soil or water quality?
Exactly. You can potentially exclude part or even all of these payments from your income, provided they are for capital expenses, things that improve your farm, like waterways or erosion control structures. This means you can get a tax-free reduction in the cost of that capital improvement.
That sounds almost too good to be true. Is there a catch?
There is potential recapture rule. If you dispose of the property you improved within 20 years, some of that excluded payment might get pulled back and treated as ordinary income.
Ah, okay, 20 years.
Right, and you also have the choice not to exclude these payments, if for some reason that makes more sense. In that case, the payment would just increase your basis in the property, meaning less gain later.
That's a powerful way to reduce current income, especially for those big conservation projects. What about patronage dividends or even canceled debts? Those seem less common, maybe.
They can be impactful, though. Patronage dividends, usually from agricultural cooperatives, are typically included as income on Schedule F. But here's an important distinction for savings. If these dividends are for buying capital assets or depreciable property for your farm business,
Like a tractor from the co-op.
exactly, then they are not included in income. Instead, they reduce the basis of that asset, essentially a tax-free reduction in its cost basis. Also, if you happen to have a loss when you redeem a qualified written notice of allocation from your farming co-op, that loss is actually deductible as an expense on Schedule F.
Okay, and canceled debt. Usually that's income, right?
Normally, yes. Canceled debt is usually taxable income. But there's another valuable exclusion here. You can exclude canceled debt from your income in specific situations, if the cancellation happens during bankruptcy or when you are technically insolvent.
Meaning your debts exceed your assets.
Right. Or if it's considered qualified farm debt. This exclusion can be a huge relief. The catch, or maybe the consequence, is that you'll generally have to reduce the basis of your property, first depreciable property, then land, etc.
So you don't pay tax now, but you might pay more later when you sell or have lower depreciation deductions.
Precisely. It defers the tax liability. And finally, just a quick reminder about barter income. If you trade your farm products or services for someone else's property or services, you have to report the fair market value of what you receive as income. The IRS treats it just like cash.
Got it. No hiding income through bartering.
Right. You know, if we step back and look at the bigger picture, many of these income rules, like the weather-related sales deferral or the cost-sharing exclusions, are really designed to offer farmers critical flexibility and relief.
Yeah, given how unpredictable farming can be.
Exactly. Understanding these nuances allows you to strategically manage your income reporting and potentially reduce your tax burdens significantly, particularly in those volatile years.
Okay, that covers income. Now, for the part everyone really loves deductions. What can farmers strategically deduct, and how can they maximize these to save on taxes?
Ah, yes, deductions. This is where proactive tax planning really shines and where you can find significant savings. Let's start with your everyday farm business expenses.
Like driving the farm truck.
Exactly. You can deduct the standard mileage rate for the business use of your vehicles. Always check the current year's IRS rate for 2024. It was 67 cents per mile.
Okay.
And for farm vehicles, there's a great simplification rule. You can elect to claim 75% business use without needing meticulous detailed logs allocating every mile, provided the vehicle is primarily used for farming during the business day.
That 75% rule sounds helpful.
It can save a lot of record-keeping hassle. For business meals, you can typically deduct 50% of non-entertainment, business-related meal expenses, especially when you're traveling overnight for farm business.
It's just 50% now.
Generally, yes, 50%. Now, prepaid farm supplies have an interesting rule we touched on. If you're on the cash method, your deduction for prepaid supplies like feed or fertilizer in the year you pay is generally limited to 50% of your other deductible farm expenses. However, this limit often doesn't apply if the prepayment has a valid business purpose. Like maybe you're locking in feed prices because you anticipate a shortage, or securing a specific fertilizer formula. If there is a good business reason beyond just accelerating the deduction, you can often deduct the full amount paid.
That's a key distinction for planning year-end purchases. What about labor costs? Especially for family members, that's huge for many farms.
Absolutely huge. This is a crucial key opportunity for tax savings on family farms. Labor hired. You can deduct reasonable wages and other compensation paid for farm labor. Here's the really valuable detail. Wages paid to your child for actual farm work are deductible, provided there's a true employer-employee relationship. You know, they have real duties, keep track of hours, get paid a reasonable wage.
Right. It has to be legitimate work.
Yes. And here's the kicker for savings. If your child is under 18, those wages are not subject to Social Security or Medicare taxes. FICA.
Wow, that's a direct saving on payroll taxes.
Significant saving for the farm. Wages paid to your spouse are also deductible, but they are subject to FICA taxes. Just be aware you generally can't deduct wages for purely household work or for major construction labor that usually gets capitalized.
Got it. What other common deductions should farmers be tracking?
Well, fertilizer and lime generally deductible in the year you pay or incur the expense. You can also deduct various taxes. Real estate and personal property taxes on your farm assets are deductible on Schedule F. And importantly, your employer's share of Social Security and Medicare taxes for your employees, plus federal unemployment tax, FUTA.
Right, the employer portion of payroll taxes is a business expense.
Correct. Also, insurance premiums for things like crop insurance, liability insurance, business interruption, and property insurance on farm assets are deductible. For cash basis taxpayers, there's a helpful 12-month rule that often lets you deduct the full premium in the year paid, even if the policy covers part of the next year.
Good tip. And for farmers running the business from home, which is so common.
Absolutely. That's a key strategic insight. You can deduct expenses for the business use of your home if a part of your home is used exclusively and regularly as your principal place of business.
Exclusively is the key word
It
there.
is. Or for meeting clients, or if you use a separate unattached structure like an office shed for business, the deduction is calculated based on the square footage and is limited by the gross income from that home-based business activity. But any amounts you can't deduct in the current year because of that limit can often be carried over to future tax years.
Okay, what about phone expenses?
For telephone expenses, the cost of business-related long-distance calls is deductible. If you have a second phone line purely for the farm business, that cost is deductible.
And cell phones.
For cell phones, you need to allocate the charges between business and personal use, and you can deduct the business portion. However, the basic cost of the first landline into your home generally isn't deductible, even if you use it for business sometimes.
Okay, and tax prep fees.
Yes, you can deduct the portion of your tax preparation fees that relate specifically to preparing your farm business schedules, like Schedule F or Form 4562 for depreciation. That part is a deductible farm expense.
Okay, so those are the sort of day-to-day, year-to-year expenses. But what about the bigger investments? The tractors, the combines, the new barns?
Yeah.
How do farmers recover those significant capital costs for tax purposes? This is where depreciation becomes such a powerful tool, right? Especially for saving money.
You're absolutely spot on. Recovering capital costs through various depreciation and expensing methods is one of the most impactful ways farmers can reduce their taxable income, especially after making large purchases. This is prime territory for tax savings.
So what are the main options here?
Okay, the first big one, a major tax optimization tool, is the Section 179 expense deduction.
Section 179. Heard of it. What does it do?
It allows you to elect to deduct the full cost of certain qualifying property in the year you place it in service instead of depreciating it over many years.
The full cost. Immediately.
Yes, up to a certain limit, which is quite generous for 2024. It was over $1.2 million. Qualifying property includes tangible personal property, like farm machinery and equipment, livestock acquired for draft, dairy, breeding, or sporting purposes, and crucially, it also includes single-purpose agricultural or horticultural structures, think grain bins, milking parlors, greenhouses, and certain storage facilities.
That's huge for cash flow, deducting a big purchase right away. Are there limits?
There are. The total amount you can expense under Section 179 starts to phase out if you place too much qualifying property in the service during the year. A phase-out threshold for 2024 was just over $3 million. Also, the deduction is limited to your net business taxable income for the year.
So you can't use it to create a loss.
Not directly, but any amount you can't deduct due to the income limit can be carried over to the next tax year, so you don't necessarily lose it. It's a powerful way to accelerate deductions into the current year. You make the election on Form 4562.
Okay, Section 179 is a big one. What else?
Then there's the special depreciation allowance, often called bonus depreciation. This is another major tax optimization strategy.
Bonus. Sounds good.
It is. It offers an additional first-year depreciation allowance on top of any regular depreciation for qualified property. For 2024, the bonus rate was 60%, though it's scheduled to phase down in future years, 40% in 2025, and so on.
So you get 60% bonus plus regular depreciation in year one.
Essentially, yes, though the mechanics involve taking bonus first. This applies to new and used MCRS property with a recovery period of 20 years or less, like machinery, as well as certain plants bearing fruits and nuts.
And you can choose not to take it.
Yes, unlike Section 179, where you elect in for bonus depreciation, you actually have the flexibility to elect out for a particular class of property if, say, you expect to be in a higher tax bracket later and want to save the deductions.
Interesting strategic choice there.
Very much so. Just be aware, similar to Section 179, if you later sell property for which you claimed bonus depreciation, any gain you have will generally be treated as ordinary income up to the amount of the bonus allowance claimed. It's recaptured.
Okay, so Section 179 and bonus are ways to accelerate deductions. What's the standard way?
The standard underlying method for depreciating most business property is MECRS. That's the Modified Accelerated Cost Recovery System. Think of MECRS as the IRS's default playbook for spreading the cost of an asset over its useful life for tax purposes.
Like a tractor or a barn wearing out over time.
Exactly. To figure MECRS, you need to know it's basically what you paid for it, adjusted for certain things. Then its recovery period, which is how many years the IRS says that type of asset is useful for tax purposes.
Are those periods standard?
Yes, they're defined by law. For example, most new farm machinery, tractors, combines, have a 5-year recovery period under the General Depreciation System, GDS. Single-purpose agricultural structures are often 10 years. General-purpose farm buildings, like machine sheds or barns not specific to one function, are typically 20 years. Breeding livestock often falls into 5 or 7 years.
Okay.
There's also an alternative depreciation system, ADS, with longer recovery periods, which is sometimes required or can be elected. You also need to consider the placed in service date and the depreciation convention, like half-year or mid-quarter. For livestock, depreciation generally begins when they reach maturity or are placed in service for their intended use. For fruit or nut trees and vines, it usually starts when they reach the income-producing stage.
So MERS is the baseline, and 179 and bonus are accelerators on top of that.
That's a good way to think about it. And one more deduction method, amortization. This applies to certain intangible costs or costs that don't fit neatly into depreciation. A key one is business startup costs. You can elect to deduct up to $5,000 of startup costs in the year your business begins, with the remainder amortized or spread out over 180 months, 15 years.
That helps ease the initial investment burden.
It does, and specific to farming and forestry, reforestation costs. You can elect to deduct up to $10,000 per year for each qualified timber property for costs to establish or reestablish a timber stand. Any costs above that $10 a K limit can be amortized over 84 months, 7 years. These amortization deductions can provide significant tax savings, especially in the early years or after major planting efforts.
Wow, lots of ways to deduct those bigger costs. But what about those tough years? Situations where the farm isn't quite turning a profit, or maybe you're just starting out and have big losses. Are there rules that could limit your deductions or even, question if your farm is a real business?
Absolutely. That's a critical area.
Yeah.
The IRS has several rules designed to limit losses, primarily to ensure farming is truly a business conducted for profit and not just a hobby-generating tax write-offs.
Okay, what are these limitations?
First, your deductions for losses from farming are generally limited by the amount you are at risk in the activity.
At risk, meaning?
It basically means you can only deduct losses up to the amount you could realistically lose in the farm business. This includes the cash you've invested, the adjusted basis of property you've contributed, and amounts you've borrowed for the farm if you're personally liable for repayment or have pledged property outside the farm as security. It prevents deducting losses funded by non-recourse loans where you have no personal liability.
So no deducting more than your actual skin in the game.
Exactly. Then, for non-corporate taxpayers, there's also an excess business loss limitation. For 2024, if your total net business losses from all your trades or businesses exceed a certain threshold, around $305,000 for single filers, $610,000 for joint returns, the excess loss is disallowed for the current year.
What happens to that disallowed loss?
It's not lost forever. It gets treated as part of your net operating loss, or NOL, carry forward to the following year.
Speaking of NOLs, how do those work for farmers?
Yeah. If your farm deductions exceed your farm income and other income, creating an NOL, there are special rules for farmers. Farming losses can generally be carried back 2 years to get refunds from prior taxes paid. Or you can elect to forego the carryback and just carry the entire loss forward to offset future income indefinitely. That choice depends on your past and expected future income situation.
Okay, that 2-year carryback is unique to farming, right?
It is one of the special provisions. Now, perhaps the most fundamental limitation and a critical point for ensuring the legitimacy of all your deductions, not-for-profit farming, sometimes called the hobby loss rule.
Proving it's a business, not a hobby.
Exactly. If your farming activity isn't conducted with the genuine intent to make a profit, your expenses generally can't be deducted beyond the amount of your farm income, even if you itemize deductions. You can't use farm losses to offset your other income like wages.
How does the IRS determine profit motive?
They look at various factors: the manner you carry on the activity, your expertise, time and effort spent, expectation of asset appreciation, your success in similar activities, history of income or losses, amount of occasional profits, your financial status, elements of personal pleasure or recreation. It's a facts and circumstances test.
Sounds subjective.
It can be. However, there's a helpful presumption of profit rule. Your farm is presumed to be engaged in for-profit if it actually made a profit in at least 3 of the last 5 consecutive tax years ending with the current year.
3 out of 5 years profit.
Right. Or specifically for activities mainly involving breeding, training, showing, or racing horses, it's profit in 2 out of the last 7 years. If you meet this test, the burden shifts to the IRS to prove you don't have a profit motive.
What if you're a new farmer and haven't had 5 years yet?
Good question. You can file Form 5203, Election to Postpone Determination, which basically asks the IRS to wait until you have 5 years, or 7 for horses, of operation before they challenge your profit motive under this presumption rule. It buys you time to establish that track record of profitability. It's essential for ensuring your farm deductions are valid from the start.
Okay, those limitations are important guardrails. Now, farms are dynamic, things are always changing. So what happens tax-wise when you sell a significant asset, or maybe even the whole farm, or if disaster strikes? These aren't everyday events, but they have huge tax implications, right?
You're absolutely right, and understanding the tax treatment of these special scenarios is key to optimizing your financial outcome during major transitions or unexpected events. Focusing on tax savings or deferral here is critical.
Okay, let's start with selling assets. Gain versus loss.
Right. First, a quick primer on gains and losses. Generally, gains from selling capital assets held long-term are often taxed at lower capital gains rates, while ordinary income is taxed at your regular higher rates. Losses can offset gains or sometimes other income.
So capital gain treatment is usually better.
Usually, yes. Now, for sales of land held long-term and depreciable property used in farming, like machinery, buildings, breeding stock held long enough, Section 1231 gains and losses come into play. This is a special category.
Section 1231.
Yeah.
What's special about it?
It offers the best of both worlds, potentially. If your net result from all Section 1231 transactions for the year is a gain, that net gain is generally treated as a long-term capital gain, getting those favorable rates.
Nice.
However, if your net result is a loss, that net loss is treated as an ordinary loss, which is fully deductible against your other income without the limitations that usually apply to capital losses. It's generally a very favorable rule for business property sales.
Okay, win-win potentially. But what about depreciation? Doesn't that complicate things?
It does. This is where depreciation recapture comes in, specifically under Section 1245 for personal property and certain other assets. When you sell depreciable property like farm machinery, equipment, purchase breeding livestock, single-purpose structures, or grain bins at a gain,
Yeah.
a portion of that gain specifically, up to the amount of depreciation, including Section 179 and bonus, you've previously claimed on that asset is treated or recaptured as ordinary income.
Ah, so the IRS claws back the tax benefit of that past depreciation at ordinary rates.
Exactly. It prevents converting ordinary income, which depreciation offset, into purely capital gain. Any gain above the total depreciation taken is then typically treated as Section 1231 gain.
So the IRS wants its share back if you sell something for more than its depreciated value. That makes sense. What about something like a like-kind exchange? I've heard that term, but what does it mean for a farmer, especially for saving tax?
That's a powerful tax deferral strategy, but with a recent major change. Like-kind exchanges, governed by Section 1031, allow you to postpone recognizing gain or loss if you exchange real property used in your business or held for investment solely for other like-kind real property.
Real property only, so land and building.
Yes, exactly. Land for land, farm building for another rental property, etc. This is incredibly useful for upgrading or repositioning farm real estate without triggering an immediate tax bill on the built-up gain. The gain is deferred into the basis of the new property.
What was the recent change?
The big change is that this like-kind exchange treatment no longer applies to exchanges of personal property.
So you can't do a tax-free trade of an old tractor for a new one anymore.
Correct, that's gone. Machinery, equipment, livestock trades of those are now treated as a sale of the old asset and a purchase of the new one. So like-kind is now strictly for real estate. There are also complex rules around exchanging property with debt, boot, and exchanges between related persons, often involving a 2-year holding period requirement.
Okay, good to know. Only for real estate now. What about selling property over time? Installment payments.
Yes, another potential tax deferral strategy is using an installment sale. If you sell property and receive at least one payment after the tax year of the sale, you can generally report the gain proportionally as you receive the payments.
Spreads out the tax hit.
Exactly. It helps manage cash flow and potentially keeps you in lower tax brackets over time. But there's a key caution here. Any depreciation recapture income we just talked about, that is generally taxable in the year of sale even if you don't receive any payments that year.
Ouch. So recapture hits up front.
Yes, and you generally can't use the installment method for selling inventory or for sales resulting in a loss.
Okay. What if something unexpected happens? Like a fire destroys a barn, or maybe a flood, or even a disease outbreak forces you to sell livestock.
Those situations fall under involuntary conversions, casualties, thefts, or government condemnations. Here's another potential tax deferral opportunity. If you receive insurance proceeds or other compensation that results in a gain because the payment exceeds your basis in the destroyed, stolen, or condemned property,
Yeah.
you can elect to postpone reporting that gain if you buy qualified replacement property within a specified replacement period. Generally, that period ends 2 years after the close of the first tax year in which you realize any part of the gain. For certain condemnations of real property, it's 3 years.
So you have time to replace the asset without paying tax on the gain immediately.
Right. And importantly for farmers, this involuntary conversion treatment allowing for gain postponement also applies specifically to sales of livestock other than poultry held for draft, breeding, or dairy purposes if they are sold solely due to disease or environmental contamination. And remember, the weather-related sales of excess livestock due to drought, flood, etc., those can also be treated as involuntary conversions, potentially giving you a longer replacement period, often 4 years in designated areas, than the standard 1-year income deferral we discussed earlier.
Ah, so potentially even more time to reinvest.
Yes. And one more point on disasters. If your farm suffers a loss attributable to a federally declared disaster, special rules allow you, the individual taxpayer, to elect to deduct that casualty loss in the tax year immediately preceding the year the disaster occurred.
So you can get the tax relief faster by amending the prior year's return.
Exactly. It can provide quicker access to cash through a faster refund.
Okay. And finally, what about selling the entire farm? That must be complex.
It is. The sale of an entire farm isn't treated as the sale of a single asset. It's treated as the sale of multiple individual assets. Your personal residence, if part of it, the land, the buildings, fences, machinery, livestock, maybe grown crops.
You have to break it down.
Yes. The total selling price needs to be carefully allocated among all these different assets, usually based on their relative fair market values. Then the gain or loss and its character, ordinary, capital, Section 1231 recapture, is figured separately for each asset. Section 1231 rules will apply to the business property portion. It's definitely a situation where you want good professional tax advice well in advance.
No kidding. Okay, beyond income, deductions, and these special sales, there's another crucial area for farmers. Self-employment and, if applicable, employment taxes. What do we need to know here to stay compliant and, ideally, save some money?
These are absolutely essential, and yes, there are planning points and potential savings here too. Let's start with self-employment tax. If you're a sole proprietor farmer or a partner in a farm partnership, you generally pay self-employment tax, SE tax, on your net earnings from farming. This covers your contributions to Social Security and Medicare.
Right, the farmer's version of FICA.
Exactly. There's a maximum amount of net earnings subject to the Social Security portion of the tax each year, $168,600 for 2024, but there's no limit for the Medicare portion, 1.45% each for employee-employer equivalent, so 2.9% total for SE.
Okay, now, farmers often have uneven income. How do estimated taxes work?
This is a big advantage for farmers regarding estimated tax. If at least 2/3 of your total gross income for the current or the prior tax year is from farming or fishing,
2/3, okay.
then you only have to make one estimated tax payment for the year, which is due by January 15th of the following year. Or even better, you can choose to not pay any estimated tax at all if you simply file your Form 1048 tax return and pay all the tax due by March 1st. Or March 3rd in 2025, since March 1st is a Saturday of the following year.
Wow, so basically no quarterly payments needed if you meet the farmer criteria and file by early March.
Correct. That can be a huge cash flow benefit compared to paying quarterly throughout the year.
Definitely. Are there other SE tax saving strategies?
Yes, there's a crucial tax saving tip involving the optional methods for calculating SE tax. There are two. the farm optional method and the non-farm optional method, though we'll focus on farm.
Okay, farm optional method.
If your gross farm income is relatively low, $10,380 or less for 2024, or if your actual net farm profits are less than a certain amount, $7,493 for 2024, you can choose to report either your actual net earnings or two-thirds of your gross farm income, up to a maximum reportable amount, $6,920 for 2024, as your net earnings for SE tax purposes.
Why would you choose to report more income for SE tax?
Great question. Primarily to get credit for Social Security coverage if your actual net earnings are very low, maybe even negative. Using the optional method allows you to still get credited with quarters of coverage towards future Social Security retirement or disability benefits, potentially up to 4 credits per year.
Ah, so it builds your Social Security record even in a low-profit year.
Exactly. It can also sometimes increase certain tax credits that are based on earned income, like the Earned Income Tax Credit or the Child Tax Credit in some specific situations. Or if your actual net profit is small but positive, using the optional method might actually result in lower SE tax in certain cases, though building credits is the more common reason.
Interesting. Very strategic. What about married couples running a farm together?
Another great point for potential simplification and ensuring both spouses get credit. For spouses who jointly own and materially participate in operating an unincorporated farm business, they can make an election called a qualified joint venture, QJV.
QJV, what does that do?
If they qualify and make this election, they don't have to file a complicated partnership return, Form 1065. Instead, they can each file their own separate Schedule F reporting their respective shares of income and expenses, and importantly, a separate Schedule SE to calculate their own self-employment tax.
So each spouse gets direct credit for Social Security earnings.
Precisely. It avoids partnership complexities while ensuring both spouses build their individual Social Security records based on their contribution to the farm. It's a great option for many farm couples.
Okay, that covers self-employment. What if you have employees working on the farm?
Right. If you have employees, then you step into the role of an employer and have employment tax responsibilities. This includes withholding federal income tax from their wages, withholding and paying the employee's share of Social Security and Medicare taxes, FICA, and paying the employer's matching share of FICA taxes. Plus, usually federal unemployment tax, FUTA.
Same rates we discussed, 6.2% Social Security, 1.45% Medicare each.
Yes, those were the 2024 rates for both employee and employer shares. On wages up to the Social Security wage-based limit for the SS part, no limit for Medicare.
And how do farmers pay these taxes over to the IRS? Is it complicated?
Federal tax deposits must generally be made electronically using the Electronic Federal Tax Payment System, EFTPS. Right. There's an exception allowing you to pay with your employment tax return, like Form 943, Employer's Annual Federal Tax Return for Agricultural Employees. If your total tax liability for the return period is less than $2,500, but generally electronic deposits are required based on your deposit schedule, monthly or semi-weekly.
Okay. Now, what about employing family members? We talked about deducting wages paid to kids.
Yes, and there are employment tax implications too. Remember, for family employees, wages paid to your child under 18 for farm work are generally exempt from both Social Security and Medicare taxes. Another significant saving.
Under 18, no FICA.
Got it. Wages paid to your spouse are subject to FICA. Wages paid to your parent for farm work generally are subject to FICA, but not subject to FUTA tax. It gets a bit tricky.
Definitely need to check the rules there. Any other special employee groups?
Yes, a key one for agriculture. H-2A agricultural workers. Compensation paid to foreign agricultural workers who are in the U.S. temporarily under the H-2A visa program is not subject to U.S. Social Security or Medicare taxes.
That's another specific exemption.
Correct. And of course, you have reporting responsibilities issuing Form W-2 to employees and potentially Forms 1099 NEC for non-employee compensation, independent contractors, or 1099 MISC for things like rents paid.
This really raises that important question you hinted at earlier. Are you categorizing your workers correctly?
Crucial point. The distinction between an employee and an independent contractor has significant tax implications for you as the employer regarding withholding, payroll taxes, and reporting. Misclassifying workers can lead to substantial back taxes, interest, and penalties. It's vital to understand the factors the IRS uses to determine worker status.
Definitely something to get right.
Absolutely.
Wow, that was a truly insightful deep dive into the farmer's tax guide. We've really unpacked a lot
So I
today.
certainly covered a lot of ground.
Everything from the foundational importance of, diligent records and choosing the right accounting method,
Which sets the stage for everything else.
right, to optimizing your income reporting, really maximizing those valuable deductions through depreciation, Section 179, bonus, all those special programs.
And navigating those complex special sales and involuntary conversions.
Exactly. And finally, tackling the complexities of self-employment and employment taxes, especially those farmer-specific rules.
Indeed. I think the key takeaway here, if there's one main point, is that tax preparation for farmers is far more than just filling out forms after the year is over.
But proactive, right?
It has to be. It's about making informed choices during the year about accounting methods, understanding every income stream and its specific nuances, and strategically leveraging every available deduction, credit, and deferral opportunity, sometimes planning years in advance.
So what does this all mean for you, the farmer listening? It really means that with careful planning and a solid understanding of these rules, maybe re-listening to parts of this, you can significantly impact your farm's bottom line, its financial health. It's truly about being proactive, not just reactive when it comes to your taxes, turning it from a burden into a tool.
So here's something to think about as we wrap up. Consider this. How might just one strategic decision you make today, perhaps regarding your choice of accounting method, or how you decide to handle a major capital expense like a new piece of equipment using Section 179 versus MACRS, how might that single decision ripple through your tax returns, not just this year, but for years to come? How could it fundamentally shape your farm's profitability and maybe even your long-term financial security?